Everyone loves the idea of cashing checks while you sleep. Dividend investing sounds like the closest thing to financial freedom on autopilot. But here's the ugly truth. Without the right approach, dividends can trap you instead of free you. In fact, most investors chasing income this way fail, not because dividends don't work, but because they misunderstand the rules. Today, I'm breaking it all down. The 7 rules that separate dividend dreams from dividend disasters. And trust me, it's not what you think. A few years ago, I met a man named Carl. He worked 30 years at a manufacturing plant, retired with a decent nest egg, and thought dividends would cover his bills forever. At first, the checks rolled in, then a recession hit. Half his holdings slashed payouts, his portfolio dropped by 6 figures, and suddenly the safe income he counted on was gone. Carl wasn't reckless. He simply didn't know the playbook. And he's not alone. Millions of investors fall into the same traps. But here's the good news. Once you learn the rules, dividends can be the most reliable wealth machine you'll ever own. You'll discover why dividend investing fails without big capital and how to fix it. Make sure to subscribe to the channel, and let's dive straight into Rule 1, the yield trap. High yield looks tempting. Who doesn't want 8% or 10% payouts? But here's the catch. Most high-yield stocks are ticking time bombs. Companies offering unsustainably high dividends often have shaky balance sheets or shrinking businesses. When earnings drop, the dividend is the first thing to go. And when that cut happens, not only does your income shrink, but the stock price usually collapses too. A double hit. Smart dividend investors know this. It's better to own a company paying a stable 3% and growing 7% every year than one dangling 10% that's doomed to fail. Growth plus sustainability beats reckless yield every time. Think of it like fishing. Would you rather grab a giant fish once that slips off the hook or reel in smaller, steady catches that add up over time? The long-term winner is obvious. But here's the part most people miss. Dividends aren't just about the number attached to the yield. They're about the story behind the business. Is revenue growing? Are margins expanding? Does management have a history of protecting shareholders? Or do they treat dividends like an afterthought? If you don't ask those questions, you're not investing. You're gambling. Another trap is the illusion of stability. A high-yield company can look attractive for months or even years, luring investors into a false sense of safety. But once debt loads grow too heavy or industry headwinds strike, the payout gets slashed overnight. And the investors who thought they found a shortcut realize they've built their income dreams on quicksand. The bottom line, chasing yield is like chasing shortcuts in life. They look appealing in the moment, but shortcuts almost always lead to setbacks. Dividends are about consistency, not fireworks. And when you align with companies that understand this, you're building income that lasts. And that brings us right to the next dividend rule. It's time to break down how to structure a portfolio built for both growth and safety. Enter the 40-30-20-10 allocation rule. Most investors overload on one sector, banks, utilities, or energy, believing they're safe simply because those industries have long histories of paying dividends. But that's like building a house with only one kind of material. It might look solid, but once a storm comes, the weak spots get exposed. The 40-30-20-10 framework provides a foundation that balances security, growth, and opportunity. 40% goes to your core, ETFs and dividend aristocrats that have decades of consistent payouts. These are your fortress holdings, the base that will keep your income reliable even during tough times. 30% should be placed in growth-oriented dividend payers. These are companies reinvesting heavily into their businesses while still rewarding shareholders. Often, these are in sectors like technology or healthcare, where dividends may be smaller now, but the growth trajectory is powerful. 20% can be dedicated to income boosters. These are higher yield plays like REITs, pipelines, or utilities, but carefully selected to avoid the yield trap we discussed earlier. This slice gives your portfolio the income juice that feels rewarding without exposing you to excessive risk. And the final 10%? Opportunistic plays. These could be turnaround stories, international dividend opportunities, or even small caps just beginning to prove themselves. This allocation allows flexibility while still protecting the majority of your portfolio from missteps. One of my favorite quotes that applies perfectly here comes from Warren Buffett. Do not put all your eggs in one basket, but if you must, watch that basket closely. The beauty of this allocation rule is that it gives you multiple baskets while teaching you how to watch them wisely. The power of this strategy isn't theoretical. It's been used to grow income streams from $35,000 to $67,000 over a single decade, not by chasing risky plays, but by balancing wisely. It's not flashy, but it's resilient. And resilience is what separates casual dividend dabblers from long-term winners. But even with balance, you need to be ready for the inevitable storms. That's Rule 3. Let's talk about surviving dividend cuts, crashes, and rate hikes. Dividend investors face three enemies that always show up at some point in the journey: cuts, crashes, and rate hikes. Cuts destroy confidence, crashes test patience, and rate hikes reveal which businesses were only strong on paper. The way to protect yourself isn't luck, it's preparation. That means building a cash buffer of at least 6 months' expenses, so when payouts shrink, you don't panic sell at the worst possible time. It also means viewing downturns as opportunities instead of disasters. When the market crashes, reinvesting dividends into discounted shares accelerates your long-term growth like nothing else. The stocks you pick up during dark times are the very ones that create explosive income years later. And then there's the silent killer: rising interest rates. Higher borrowing costs crush companies with heavy debt, forcing them to cut payouts or slow growth. That's why investors who prioritize low-debt businesses with pricing power always come out stronger. When costs rise, these firms simply pass them to customers instead of letting shareholders suffer. It's helpful to think about this like insurance. You don't buy car insurance expecting to crash tomorrow. You buy it so a single accident doesn't ruin your entire life. Dividend insurance is the same. Cash buffers, reinvestment discipline, and strong balance sheets don't feel exciting when the sun is shining. But when storms hit, they're the difference between staying in the game and being wiped out. And here's the reality: storms always come. The question isn't if, it's when. So build your dividend portfolio like a ship that can sail through rough seas, not just calm waters, because the true test of an investor isn't how they act when everything is rising. It's how they act when everything feels like it's falling apart. By the way, if you're enjoying the video so far and want more topics like this, comment the word "more" so I know. Now, let's talk about which vehicles actually hold up for the long haul. We're diving into the ETFs built to last for decades, with Rule 4. Not every investor wants to pick individual stocks. And honestly, you don't need to. Some ETFs have quietly delivered consistent dividends for more than a decade, acting like automatic filters that keep only the strongest players in your corner. Funds such as Vanguard Dividend Appreciation, VIG, and Schwab U.S. Dividend Equity, SCHD, are powerful examples. They focus on companies with proven track records of raising payouts year after year, often through multiple economic cycles. That means when weaker businesses fall out, the ETFs naturally replace them with stronger ones, keeping your portfolio lean and effective without constant monitoring. Think of these ETFs as professional gardeners. Instead of watering every plant yourself, the system ensures your income garden keeps blooming season after season. You don't stress about one plant dying because the gardener is already planting a healthier one in its place. The beauty here is psychological as well as financial. Owning a basket of dividend growers means you avoid the emotional roller coaster of individual company failures. A dividend cut from one stock doesn't derail your entire plan. It just becomes a minor footnote in a much bigger, healthier story. This approach also saves time. You don't have to analyze every balance sheet or earnings report. You can let the ETF structure do the heavy lifting while you focus on consistency and reinvestment. But even with the best ETFs, your emotions will still get tested. Which brings us to Rule 5, the human side of dividend investing. Dividend investing isn't just math, it's psychology. And the truth is, every investor moves through emotional phases that can either make or break their journey. First comes excitement. Those first payouts feel magical. You see money appearing in your account without lifting a finger, and you start imagining how big this can get. But then comes doubt. Growth feels slow, payouts look small, and you wonder if this whole compounding thing is overhyped. This is the most dangerous phase because it convinces people to quit right before the breakthrough. The third phase is conviction. This is when the snowball becomes real. Your reinvested dividends finally start building momentum, and you see how unstoppable the machine can be when you simply stick with it. Most people never make it here, but those who do unlock the true magic of dividends. This is the point where I want to share something special. We're building the Trip to Wealth Command Center, a complete financial toolkit designed to help you track your income streams, monitor reinvestments, and watch your dividend snowball grow in real time. It's still under construction, but you can join the early access waitlist today. By getting in early, you'll be supporting the launch and locking in your exclusive discount. The link is right below. Don't miss it. The truth is, emotions decide more outcomes than spreadsheets. And the investors who win aren't necessarily the smartest. They're the ones who master their psychology. Of course, conviction helps, but let's add another rule that accelerates the dividend journey. Reinvest like a machine. The most underrated strategy in dividend investing is also the simplest. Reinvest every single payout automatically. When you collect dividends and let them sit idle while you decide later, you lose momentum. But when you reinvest immediately, you transform your portfolio into a self-feeding wealth machine. Think of it like compound interest in the gym. You don't get strong from working out once in a while, you get strong by showing up consistently. Each reinvested dividend is like another rep, another set, another brick in the wall. The secret lies in automation. Dividend reinvestment plans, or DRIPs, make the process effortless. The moment dividends hit, they buy more shares. Those new shares pay more dividends, and the cycle repeats without your involvement. 10 years of this discipline can add tens of thousands in extra income that would have been lost if you tried to time reinvestments manually. It's not glamorous. You won't brag about reinvesting a $42 dividend check, but fast forward a decade, and those small reinvestments compound into an income stream that can rival your paycheck. That's the quiet power most people overlook. And finally, Rule 7, the mindset that separates dabblers from lifelong dividend winners. Think in decades, not days. Dividend investing isn't about chasing thrills. It's about compounding quietly over decades. The investors who thrive don't obsess over short-term swings. They anchor themselves to a 10, 20, or even 30-year horizon. Here's the test. If the market closed tomorrow and you couldn't touch your portfolio for 10 years, would you still be comfortable owning your dividend stocks? If the answer is yes, you're doing it right. If the answer is no, you're probably chasing hype, not building wealth. The truth is, decades act like filters. They strip away the noise of headlines, the distractions of quarterly earnings, and the temptations of hot picks. What remains is the steady upward curve of compounding. That's why patience isn't just a virtue in dividend investing, it's the entire game. Every reinvested dividend, every balanced allocation, every calm response to market chaos is a seed planted. The harvest doesn't appear in days or weeks, but in decades. When you embrace this perspective, investing feels lighter. You stop reacting emotionally to every blip. You understand that wealth is built quietly, behind the scenes, while you're living your life. We've covered a lot today, so let's bring it all together in one clear roadmap. First, avoid the yield trap. Don't let flashy numbers seduce you into weak companies that can't sustain payouts. Strong fundamentals beat reckless yield every single time. Second, use the 40-30-20-10 allocation framework. It's not just about spreading risk. It's about building layers of protection, growth, and opportunity into your portfolio. That structure allows you to weather storms and still grow stronger over time. Third, prepare for the three enemies of dividend investing: cuts, crashes, and rate hikes. None of them are permanent if you're prepared. Cash buffers, reinvestment during downturns, and sticking with low-debt businesses turn disasters into opportunities. Fourth, lean on proven ETFs. They act like automatic gardeners, pruning weak companies and planting stronger ones without you needing to manage every detail. That's how you save time, reduce stress, and still stay on track. Fifth, master your emotions. Excitement gets you in the game, doubt tries to kick you out, and conviction keeps you playing long enough to win. Sixth, reinvest like a machine. Don't let a single payout sit idle. Every reinvested dollar is a soldier fighting for your financial freedom. Automate it, trust the process, and let the snowball roll. And seventh, think in decades, not days. Compounding doesn't reward the impatient. The real wealth transfer happens slowly, silently, and only for those willing to give it time. Now here's the bigger truth. Dividend investing is often painted as boring, but boring is beautiful. While others chase trends, swing from one hot stock to the next, or try to outsmart the market, dividend investors quietly build an engine that produces cash flow year after year. It may not turn heads today, but 10, 20, 30 years from now, the difference is night and day. You'll be sitting on an income stream that feels unshakable, because you didn't quit when it felt slow, and you didn't fall for traps when it looked easy. So when people say, dividends don't work without big capital, remember this. The rules matter more than the size of your starting portfolio. Discipline, balance, reinvestment, and time can turn modest beginnings into extraordinary outcomes. Remember, this video is for educational purposes only and does not constitute investment advice. It is important to conduct thorough research and consult with financial professionals before making any investment decisions. The value of investments can fluctuate, and past performance is not indicative of future results. Always assess your risk tolerance and investment goals before allocating your capital. If you found value today, I highly recommend watching my next video. Don't forget to like, share, and subscribe to our channel. Also, feel free to leave your comment below, especially if this video made you think differently. I appreciate your support more than you know. Until next time, stay consistent, stay patient, and stay winning. See you in the next one, Money Magician.